Hi there. I had to look at this market today from scratch, knowing what I know about record highs, closed-end funds, AI spending, oil shocks, and how fast investor mood can flip. I would not start with the price chart. I would start with the timing. Because the timing is the whole story. The market is near highs. People are nervous. Everybody wants a cleaner entry. And right into that tension, Bill Ackman is launching Pershing Square USA and saying basically this is still a good moment to put serious capital to work. Today is Thursday, April 30th, New York time. Comment below what day and date you are watching from because this market can feel completely different depending on when you press play. And if this kind of clear market breakdown helps you, subscribe and comment John A.G. Best, so I know you value the work. Now this is not just a fund launch, it is a test. It tests whether retail investors still want star manager exposure. It tests whether closed-end funds can get attention again. And it tests whether people are brave enough to invest when the market looks expensive on the surface. So let's untangle it. There are two different things here, and mixing them up can lead investors to the wrong conclusion. Pershing Square Inc. is the management company. That is the operating business around the investment machine. Pershing Square USA, trading as PSUS, is the closed-end fund. That is the vehicle built to hold investments. Those are not the same thing. One is like owning part of the manager, the other is like owning the portfolio the manager creates. Different risks, different rewards, different reasons to buy. And that distinction matters because the deal was structured in a way that gives fund buyers a small piece of the management company too. Based on recently published numbers, investors who bought the fund at the offering price also received a fractional piece of the manager. That was the sweetener, because closed-end funds have a problem. They can trade below the value of what they own. Unlike a normal open-end fund, you do not just redeem your shares and walk away at net asset value. You sell on the market. And if buyers are skeptical, the price can drift under the assets inside. And we saw that risk immediately. The fund was offered around $50, but early trading came in lower, somewhere in the low 40s. So day one already gave investors a message. The brand is powerful. But the structure still has to earn trust. Now, to be fair, the launch was still huge. It raised around $5 billion. And a big portion came from institutions, not just small investors clicking buy because they recognize the name. That matters. Institutions do not remove risk, but their participation tells you this was not only a social media moment, this was real capital. And remember, the earlier attempt to bring this vehicle public was pulled, so this launch is not just a victory lap. It is also a second try after the market demanded a cleaner, more convincing structure this time around too, publicly. Still, investors have to understand what they are actually getting. On day one, the fund is not magically a fully invested portfolio of wonderful businesses. A lot of it begins as cash. So when you buy early, you are making a bet on future deployment. You are not only buying what exists today, you are trusting what will be built tomorrow. And that is why the manager matters so much here. Ackman's pitch is that Pershing Square has a long record of concentrated investing, not hundreds of tiny positions, not closet indexing, not let's own everything and hope the average works out. This is a focused portfolio approach, maybe around a dozen companies, maybe a little more. Sometimes the largest few positions can dominate the portfolio. That can create big outperformance if the choices are right. It can also create real pain if the wrong holding cracks. That is concentration. It multiplies both judgment and mistakes. Now, the bullish argument is very simple. If a manager has historically found high-quality companies, entered at attractive prices, and worked with those businesses in a way that improves outcomes, then a concentrated fund can beat an index over long periods. The skeptical argument is also simple. A strong past record does not make the next purchase cheap. It does not make volatility disappear. And it does not protect you from paying a premium for a famous name. This is where most investors get trapped. They want a clean answer. Is it good or bad? Buy or avoid? Genius or hype? Markets rarely work like that. The better question is, what has to go right? For PSUS to work well, the cash has to be deployed into the right companies. The fund needs to avoid a lasting discount problem. The manager has to keep discipline, and the underlying businesses need to compound faster than the price investors paid. That is a lot, but it is also what every active strategy faces. The only difference is that this one is happening in public, with a famous name attached under bright lights at market highs. And that makes the psychology louder. Now, why would Ackman argue this is a good time? Because he is looking at dispersion. The market is not one thing. Some stocks are stretched. Some are fair. Some are hated for temporary reasons. Some large companies are still growing faster than large companies used to grow. That last point is important. In the old market playbook, giant companies were supposed to be slower. The small names were where fast growth lived. But today, some of the biggest companies in the market are also driving the biggest profit pools, the biggest AI budgets, and the biggest infrastructure demand. That changes valuation math. It does not mean every mega cap is cheap. Please do not hear that. It means the old comparison is incomplete. If a company is growing earnings, building cloud capacity, monetizing AI tools, and sitting on a fortress balance sheet, it deserves a different multiple than a slow business with no pricing power. But again, price still matters. Based on recent market updates, AI infrastructure spending is still one of the strongest forces under the economy. Data centers, power equipment, cooling systems, chips, grid upgrades, construction, and energy supply are all connected now. AI is no longer just a software story. It is becoming a physical build-out. That is why this market can look expensive and still have pockets of real demand underneath. But there is a risk on the other side of that. When everyone believes one theme is unstoppable, capital floods in. Then expectations get too high. Then even good earnings can disappoint if investors expected perfection. That is how bubbles form inside real trends. The trend can be real, and the stock can still be overpriced. Now let's talk about the macro setup, because this is where the story gets bigger than Pershing Square. The Federal Reserve just kept rates in the mid 3% range, and the reason is not hard to understand. The economy has resilience, but inflation risk has not vanished. Middle East uncertainty is adding another layer. Energy prices can quickly make a neat rate cut story messy. And that matters for this fund. Why? Because lower rates can support equity valuations. They make future cash flows more attractive. They make financing easier. They encourage risk-taking. But if oil keeps inflation sticky, the Fed has less room to move. Oil talks to inflation. Inflation talks to the Fed. The Fed talks to markets. Recently published inflation numbers showed the energy category jumping sharply, with gasoline rising roughly a fifth in 1 month. Headline inflation moved back into the low 3% range, while core inflation stayed calmer, in the mid-2s. That is exactly the split the Fed hates. Core looks manageable. Energy screams caution. So when Ackman points to Iran and oil as a main overhang, that is not random. A short spike in oil is painful, but markets can absorb it. A long stretch of elevated oil is different. It hits trucking, airlines, plastics, fertilizer, food, shipping, and consumer confidence. Energy is not just another line item. It is the input behind the inputs. From current energy forecasts, crude could stay elevated in the near term and then ease later if supply disruptions fade. That if is doing a lot of work. Because if the conflict lasts longer or if shipping routes stay stressed, the market has to reprice the whole inflation path again. And if the inflation path changes, the rate path changes. And if the rate path changes, the valuation argument changes. So this is not a simple bullish story. It is conditional. The optimistic case says the economy remains strong, AI spending continues, policy supports domestic investment, companies keep earning, and energy pressure cools enough for the Fed to eventually get more flexible. The cautious case says the market is already pricing in too much of that good news, oil stays too high for too long, and closed-end fund investors demand a discount because they do not want to wait for deployment. So which side wins? Probably not all at once. Markets move in phases. First, they reward the story, then they test the numbers, then they punish the weakest assumptions. That is why you need to know what you own. If you buy PSUS, you are not buying an index fund. You are buying a manager, a structure, and a concentrated strategy. You are buying the possibility of active outperformance, but also the risk that the market says, I like the assets, but not at that share price. Closed-end funds can be frustrating like that. You can be right about the investments and still watch the fund trade at a discount for a while. That is why patience matters, and that is why the entry price matters. Now, there is another part of the Pershing Square story that people love, and that is hedging. The firm has a history of making major hedges around crisis risks, credit stress, pandemic shock, inflation and rate pressure. The idea is powerful. When danger is mispriced, buy protection. If the danger arrives, the hedge pays. Then use that money to buy assets when everyone else is forced to sell. Beautiful in theory, hard in practice, because hedges cost money. They can expire worthless. They can look foolish right before they look brilliant. And if you build your whole personality around predicting disaster, you can miss the compounding happening right in front of you. So I like the hedging capability. I just would not treat it like free insurance. Nothing in markets is free. Now, for regular investors, the bigger lesson is not whether Ackman is right this quarter. The bigger lesson is how professionals think about time. They do not ask, will the next 90 days be smooth? They ask, can this capital compound over years? Can we own the right assets through volatility? Can we use panic instead of being used by it? Most retail investors lose because they do the opposite. They wait when prices are rising. They buy after the story is obvious. They sell when volatility gets loud. Then they blame the market. No. The market is just the arena. Your behavior is the opponent. If you're successful, share your success story in the comments so others can stay motivated. And keep this part close. You do not need to copy a billionaire to become a better investor. You need a process. Know your cash needs, know your risk tolerance, know why you own what you own. If you cannot handle a drawdown, do not build a portfolio that requires hero-level emotional control. Keep enough cash so you can breathe. Not so much cash that inflation quietly eats your future, but enough that you are not forced to sell good assets during ugly weeks. That balance is personal. A 25-year-old investor with steady income and no major obligations can usually take a different level of risk than someone near retirement. A business owner with uneven cash flow should think differently than an employee with predictable paychecks. A parent with tuition bills should not copy a hedge fund manager's risk profile. So here is the clean takeaway. Pershing Square USA is interesting because it gives public investors access to a concentrated, high-profile investment strategy in a U.S.-listed vehicle. The launch is important because it happened near market highs after a previous attempt failed, and during a macro environment where AI, rates, oil, inflation, and policy are all pulling on the market at the same time. But it is not automatically a buy just because the manager is famous. And it is not automatically a bad idea just because the first trade was messy. It is a vehicle. A vehicle can take you somewhere useful, or it can take you somewhere you did not mean to go. The driver matters, the road matters, the price of the ticket matters. So if you are thinking about it, study the structure, study the discount risk, study the holdings when they become clear, study the fees, study your own time horizon. And most importantly, ask whether you are investing because you understand the thesis or because the name makes you feel safe. Famous names do not remove risk. They just make risk easier to ignore. The best investors respect both sides. They can be optimistic without being careless. They can buy near highs without pretending prices do not matter. They can admire a track record without outsourcing their brain. Because markets are not waiting for perfect conditions. They never have. Opportunities usually arrive wrapped in uncertainty, with some piece of the story still uncomfortable. That is why they are opportunities. And right now, the uncomfortable pieces are obvious. Oil, inflation, rates, valuation, fund structure, deployment timing, but the supportive pieces are also obvious. AI spending, corporate earnings, U.S. capital formation, institutional demand, long-term compounding, and a market that keeps proving it can climb a wall of fear longer than most people expect. So do not reduce this to a headline. This is not just Ackman says buy. It is not just fund drops on debut. It is a live case study in how serious capital moves when the crowd is divided. And that is why we watch it, not to worship it. To learn from it. This video is for education and perspective only. I am not your financial advisor, and I am not telling you to buy Pershing Square USA, sell it, avoid it, or chase it. Use this as research fuel, compare it with your own situation, and make decisions that fit your risk, your timeline, and your actual life.